Picture this. It's not a war zone. It's not a collapsing country. It's a clean, modern solar factory in China. Conveyor belts hum. Robotic arms glide. Every panel rolling off the line contains a thin, almost invisible layer of silver. Not gold. Not copper. Silver. Now zoom out. That factory is one of thousands. Solar installations are being added at record pace. Electric vehicles are replacing combustion engines. Data centers are expanding to feed AI. And every single one of these systems consumes silver permanently. Not stored. Not recycled efficiently. Consumed. Gone. Now here's the part most people miss. While demand for silver has been quietly compounding year after year, supply hasn't kept up. Not even close. And unlike oil or copper, silver production can't just be turned up when prices rise. That imbalance is why silver hasn't just gone up recently. It's why it's been structurally tightening for years. The price move you're seeing now isn't a spike. It's a release of pressure that's been building for over a decade. And yet, most investors still treat silver like a side character. A cheaper version of gold. A speculative trade. Something you flip when momentum fades. That misunderstanding is exactly why silver moves the way it does. Violently. Suddenly. And often too late for people to react. By the end of this video, you'll understand why silver behaves differently from every other major asset, why its recent rise isn't random or hype-driven, and why history suggests that when silver finally breaks, it doesn't move gradually. It reprices. To understand what's happening now, we need to start with what silver actually is. Silver is not just a precious metal. It's not just an industrial metal. It's both at the same time. And that dual identity is what makes it uniquely volatile, uniquely misunderstood, and uniquely powerful during certain economic conditions. Historically, silver was money. For thousands of years, silver circulated as currency alongside gold. The word salary comes from salt, but wages across empires were often paid in silver. The Roman denarius, Spanish pieces of 8, Chinese silver taels. When governments debased their coinage, silver didn't disappear. It flowed elsewhere. That matters because it means silver already has a monetary memory embedded in human behavior. When trust in currency weakens, silver doesn't need to convince people it has value. It's remembered. But unlike gold, silver never fully escaped industrialization. Today, more than half of annual silver demand comes from industry. Solar panels, electronics, medical equipment, chemical catalysts, batteries, water purification, semiconductors. And here's the key distinction. When industry uses silver, it doesn't come back. Gold gets stored. Silver gets used. Now layer that reality onto the modern world. Global electrification isn't slowing down. AI infrastructure isn't shrinking. Green energy mandates aren't reversing. Every one of these trends consumes silver in small amounts per unit, but at massive scale. And silver doesn't substitute easily. Copper conducts electricity well. Silver conducts it best. In high-precision environments, there is no cheaper replacement that performs the same function. So, demand keeps climbing, quietly, relentlessly. Now look at the supply side. This is where silver becomes truly constrained. Unlike gold, most silver is not mined on its own. Roughly 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. That means silver supply doesn't respond to silver prices. It responds to base metal economics. If copper demand slows, silver production slows, even if silver prices are rising. That's a structural bottleneck. And it gets worse. New silver discoveries have been declining for years, or grades are falling. Environmental regulations are tightening. Capital costs for new mines are rising. It takes over a decade to bring a new mine online. Silver cannot suddenly flood the market, no matter how high the price goes. This is why the silver market has been running persistent deficits. Year after year, more silver is consumed than produced. Inventories get drawn down. Exchange vaults get thinner. Above-ground stockpiles shrink. And because silver is relatively small compared to other markets, it doesn't take much additional demand to create price pressure. Now add monetary forces to this already tight physical market. Silver doesn't just respond to industrial cycles. It responds to money itself. Interest rates, currency strength, inflation expectations, debt levels. When real interest rates fall, meaning inflation outpaces yields, holding cash becomes expensive. That's when non-yielding assets like silver become attractive. Not because they pay income, but because they don't decay. Over the past few years, global debt has exploded. Governments are running chronic deficits. Central banks expanded balance sheets at historic scale. Even as inflation cooled from peaks, it remains structurally higher than pre-2020 norms. The result is persistent pressure on fiat currencies. And when confidence in paper weakens, even slightly, precious metals respond. But silver responds differently from gold. Gold moves first, silver follows later, then silver overshoots. This pattern repeats across history. In the 1970s, gold rose steadily as inflation accelerated. Silver lagged, then silver exploded, rising over 400% in a few years. In 2008, gold stabilized first. Silver collapsed initially, then surged nearly 450% by 2011. Silver doesn't hedge uncertainty early. It reacts when pressure becomes undeniable. Why? Because silver sits at the intersection of fear and growth. When economic conditions deteriorate but industry still consumes, silver gets pulled from both sides. Investors buy it as money insurance. Industry buys it because production can't stop. That creates a squeeze. And squeezes in small markets don't unwind gently. Now look at the past few years specifically. Industrial demand surged due to solar installations alone consuming hundreds of millions of ounces annually. At the same time, investment demand returned as inflation proved stickier than expected and geopolitical risk escalated. Wars, sanctions, supply chain fragmentation, currency weaponization. All of this pushes countries and investors toward tangible assets. Silver ETFs began accumulating again. Futures positioning tightened. Physical premiums rose in key markets, not because of hype, but because metal was harder to source. When physical silver becomes scarce, paper markets lose credibility. And when that happens, price discovery accelerates. There's also the gold-silver ratio. Historically, gold and silver trade within a range. When the ratio stretches too far, it snaps back. For much of the past decade, silver was historically undervalued relative to gold. That imbalance doesn't correct overnight. It corrects violently. Now here's the psychological trap. Because silver is cheaper per ounce, people assume it's less important, but price per unit is irrelevant. Market size matters. The entire annual silver market is tiny compared to equities, bonds, even gold. That means marginal flows matter more. A relatively small reallocation of capital can overwhelm supply. This is why silver rallies feel sudden. They aren't caused by sudden events. They're caused by long-building pressure finally reaching a breaking point. At the same time, central banks have largely ignored silver. They accumulate gold. They don't hold silver reserves anymore. That creates another dynamic. Gold gets institutional support. Silver gets neglected until it can't be ignored. When silver finally moves, it's not driven by policy, it's driven by physics, supply, demand, and scarcity. Now let's address the misconception that silver is too volatile to matter. Volatility is not randomness. Volatility is compressed energy being released. Silver's volatility exists because it's small, essential, and misunderstood. When markets are calm, silver drifts. When systems strain, silver snaps. That brings us to the present. Over the past months and years, silver has risen not because of speculation alone, but because the underlying conditions finally aligned. Structural deficits, exploding industrial demand, monetary pressure, currency debasement fears, relative undervaluation, tight physical supply. This isn't a bubble phase yet. Bubbles require mass participation. Silver still isn't widely owned. Most portfolios have zero exposure. Media coverage remains minimal compared to tech stocks or crypto. That's not euphoria. That's early recognition. And here's the critical point. Silver doesn't need everything to go wrong to rise. It only needs enough things to stop going right at the same time. Growth slowing without collapsing. Inflation cooling without disappearing. Debt expanding without resolution. Energy transition continuing regardless of economic cycles. That environment is silver's sweet spot. Gold protects against monetary failure. Silver benefits from monetary stress and industrial continuity. That's a rare combination. Now consider what happens next if these trends persist. Supply deficits continue. Industrial demand keeps rising. Inventories thin further. At some point, price must rise enough to destroy demand or incentivize new supply. But demand is inelastic. Solar panels don't stop being built because silver is expensive. Electronics don't redesign overnight. And supply can't respond quickly. That means price becomes the balancing mechanism, not gradually, abruptly. This is why silver historically doesn't trend smoothly upward. It stairsteps. Long periods of consolidation, then sharper pricing, then consolidation again at higher levels. Most people miss those moves because they're conditioned to think linearly. Silver is not linear. It's punctuated. And that brings us to the real takeaway. Silver's rise over the past months and years is not a story about momentum. It's a story about structural imbalance finally asserting itself. The price is not predicting the future. It's reacting to the present, catching up with the past. If you only see silver as a trade, you'll always be late. If you understand it as a pressure valve in the global system, its behavior makes sense. Now let's talk about what silver is not. Silver is not a perfect hedge. It's not immune to crashes. During liquidity crises, silver often falls hard initially. In 2008, silver dropped over 50% before it exploded higher. Why? Because in panic, everything gets sold. Margin calls don't care about fundamentals. But what matters is what happens after the forced liquidation ends. Silver rebounds faster and harder than most assets because its underlying scarcity hasn't changed. Liquidity events reset prices temporarily. They don't reset reality. This distinction is critical. People who fear silver's drawdowns miss its recoveries. People who understand cycles use volatility rather than fearing it. Now consider silver relative to other assets during periods of currency stress. Bonds fail because fixed payments lose purchasing power. Cash fails because inflation erodes it. Real estate depends on leverage and credit availability. Equities depend on earnings stability. Silver doesn't rely on promises. It doesn't default. It doesn't dilute. It just exists. That's why silver historically performs best not during prosperity, but during transition. When systems change. When old assumptions stop working. Look at emerging markets experiencing currency pressure. Silver demand often rises not because people expect profits, but because they expect survival. Small, portable, divisible, globally recognized. Those properties matter when trust weakens. Now zoom back out globally. The world is fragmenting economically. Trade blocks, sanctions, currency diversification. Countries are quietly reducing dollar exposure. Supply chains are being reshored or friendshored. Efficiency is being sacrificed for resilience. Resilience costs money. It also consumes resources. Silver sits right at the center of that transformation. It enables electrification, digitalization, and redundancy. At the same time, it hedges against the monetary consequences of building that redundancy. This dual role is why silver doesn't behave like a tech stock or a commodity or a currency. It borrows traits from all three. Now ask yourself this. If silver were truly irrelevant, if it were easily replaceable, if supply could expand effortlessly, would governments, industries, and investors keep needing it? Or would it have faded decades ago? It hasn't. It's become more embedded, not less. The irony is that silver's importance increased as its visibility decreased. Gold stayed in the spotlight. Silver became background infrastructure. That's why its repricing shocks people. They forgot it was there. And that leads to the final lesson. Markets don't reward what's obvious. They reward what's necessary and overlooked. Silver fits that profile uncomfortably well. This doesn't mean silver goes up forever. Nothing does. But it does mean that its recent rise is not a mystery, not manipulation, not mania. It's a rational response to years of imbalance finally reaching critical mass. History shows that when silver moves, it doesn't ask for permission. It doesn't wait for consensus. It forces repricing until equilibrium returns. Then it sleeps again. The question isn't whether silver will fluctuate. It will. The question is whether you understand why it moves when it does, or whether you'll be left reacting after the pressure is already released. Because the real danger with silver isn't volatility. It's ignoring it until it reminds you why it matters. If this breakdown helped you see silver differently, not as a trade, but as a structural signal, then you already understand more than most market participants. History doesn't repeat exactly, but the mechanics stay the same. Scarcity, demand, money, and trust. Silver sits at the intersection of all four. And that's why it's been rising, quietly, relentlessly. And if history is any guide, not finished yet.